Good morning, everyone, and welcome to the 2025 budget and technical update. So we've added technical update as well as budget update. Obviously, the budget, there wasn't too many massive things that were announced. But there were some other interesting things alongside the budget that the government and ASIC have released recently. So it's probably worth going over some of those technical aspects as well. I'm going to pause a couple of times to see if there's any questions. So if you wanted to pop any questions in, I'll try and get to them either during the session or we'll come back later and answer them following the session. So we're going to go over the overview of the budget, what was announced, the taxation changes, the superannuation changes that were and were not announced, and what bills are currently outstanding, and what would happen to them once an election's called. Social Security, not much there, but we might just touch on deeming rates and a couple of other things. And as I mentioned, other measures and updates is probably worthwhile going over. There's some things in for discussion and feedback that the government's released, especially in the delivering better financial outcomes space. And also ASIC have released something recently as well, which is very relevant for financial advisors, and it's important to be across what those changes are as well. So let's kick off in relation to the budget and what was announced. Now, I'll always like to start off with a bit of trivia in relation to the budget. We had piggy banks last time, I think. Where do they come from? But what about retirement nest egg? Why do we use that term? It originated from the practice of farmers putting eggs into the nest of hens to induce them to lay even more eggs. So that's why we started using retirement nest egg. So when you walk away from this webinar, hopefully you've learned one thing already. And just to make sure you're all paying attention and up and about, this is in relation to household debt. So not government debt, household debt. As a percentage of GDP, which country has the highest household debt? So I've given you 4 countries to choose from. I'm going to launch a quick poll. And I'm launching that now. So have a go. Which country, as a percentage of GDP, has the highest household debt? Who do you think that is amongst those 4 countries? Give you a little bit of a clue. All 4 countries are up there. They're in the leading pack. Okay, just because Australia obviously has got debt, the government debt, but we're probably fairly low compared to a lot of other countries. But what about household debt? So just another couple of seconds. Thanks for everyone who's had a go at answering that, which is majority of people, which is great. Thank you. Hopefully no one cheated. And let's share the results. So most people think Australia, followed by USA. So let's stop sharing. Well, according to the IMF, this is the result. So Switzerland is actually the highest and Australia comes in second. Now, I know the USA has got a lot of government debt, and that's probably what people were thinking of. But in terms of household debt, we're currently getting the silver medal, which is probably not that great. Switzerland, which definitely surprised me when I saw that as well. Before we get in the detail, where did the budget estimates come in? So as you know, we had 2 surpluses recently, and now going forward, we're projecting deficits, as you can see in that graph on the left-hand side, and the net debt. So it was kind of evened out because we had surpluses and we weren't going into further debt. But now again, the net debt is supposed to grow. But as I said, at a government level, it's probably, when you compare it to other countries, we're not too bad. And no one's really got a plan of turning that around at the moment. Good news is that after we had quite a few years where CPI was growing faster than wages, and which wasn't good, and everyone felt like they were going backwards, but that's turned the corner recently. So wages have now gone faster than CPI, and Treasury, these are the Treasury numbers here, have made these economic assumptions as part of the budget. It's good to see inflation coming back into that 2.5, no, around 2.5, between 2 and 3%. Of course, all our projections in Xplan, we use a 2.5% long-term assumption. Now, obviously, those numbers jump around a bit, but if we look back the last 15 years, it's almost exactly 2.5% is what it's averaged. So which is smack in the middle of the band that the RBA is targeting. So and it's an important number for us because everything in future dollars is brought back to today's dollars, discounted by that 2.5%. All right, so let's get into some of the detail and what was announced as part of the budget. I suppose the one big surprise was in relation to taxation, because we recently had the tax cuts that went through. There wasn't much expectation of another tax cut, but there was a small one announced. But it's not to start until 26, 27, and it's in relation to the lower marginal tax rate, the 18,200 to the $45,000 bracket, moving from 16% down to 15%, then down to 14%. So that's pretty much would be a tax cut for every taxpayer, because obviously everyone that's earning anyone paying income tax would be benefiting from that. And if we have a quick look at those tables for 26, 27, so if you're earning $45,000 or over, you'd get a $268 tax cut, and that would go up to $536 in 27, 28. And the government's tried to rushing it through, so it actually already passed the House of Representatives. And now it's gone to the Senate. So I think on budget night, no one really expected this to go, no one really expected anything to go through, because an election's going to be called pretty soon. But who knows? This one might be legislated now if the government's trying to get it through in a hurry. What that does bring up is it would be interesting if the lower marginal tax rate then falls below the contributions tax rate of 15%. So whether hopefully a future government, current government, whoever would look at changing that, because it does seem a little bit unfair for lower income earners if you're paying a marginal tax rate, then or you're paying contributions tax higher than your marginal tax rate. It doesn't really give you much incentive at all. So even just forgetting about voluntary contributions, the low income super tax offset hasn't kept up. I mean, when it was brought in, the lower threshold was 37,000, and it was based on that figure, and it was based on a lower SG figure as well. I think it was either 9 or 9.5% when it was brought in, and so that's how they came up with the figure of you can get $500 back. Basically, it's a refund of your contributions tax, which is done automatically when you do your tax return. So that hasn't kept up. I know a lot of industry super groups have been lobbying for that to change. Just as an example, if someone's on a $28,000 salary and next year when SG goes to 12%, you could be paying contributions tax of $504. Now you'll get $500 of that back because of this dough. But anything above that, you're paying a higher contributions tax than, if this does get legislated, than your marginal tax rate. So again, that just seems a little bit out of whack. And hopefully a government will have a look at that and increase those thresholds and amounts that the lower super tax offset would pay, because I think, as you know, superannuation is favouring the middle and higher income earners, and so this is kind of a disincentive for the lower income earners. I think I mentioned this every year. I don't know why, but we have to wait until nearly the end of the financial year to find out what the Medicare levy income thresholds are. So they always get announced on budget night, and they were announced again. So now we know what they are. So shout out to Carlo and the team. They've updated the calculators to already to make sure that we've got those new numbers in the calculators to have the correct Medicare levy thresholds factored in. I'll just pause there. We've got a couple of questions. So Sean, I just saw your question, and hopefully I kind of covered that a little bit. Hopefully it's something. I know the Super Member Councils Australia, ASFA, all those have been lobbying for that low income super tax offset to be increased. So hopefully that gives that some impetus and that gets changed. Very good. Thanks, Sean. Okay. Superannuation. Well, there wasn't really any superannuation announcements, which is very unusual for a budget, of course. I thought I'd just revisit very quickly, well, the government, yeah, some people say the extra tax on 3 million, the government kind of flips that around and calls it the tax concession reduction on super balances over 3 million. It's still, passed the House of Representatives. It's been sitting in the Senate for a while. I went to a committee. The committee said, no, go ahead, play on. So no change. Now, it hasn't been able to go through. There was no announcement in the budget about this, so I'm assuming that it's still Labor's intent to put it through. It's still part of their policy, still part of their long-term, budget projections. Excuse me. Excuse me. But the coalition's been voting against it. So if an election's called, which we would think be soon, all these bills get dissolved and it'd have to be reintroduced into a new parliament. So looking like not much is going to happen in the short term. We'll have to wait and see. So it was due to come in 1 July 2025, which is looking very unlikely now. But whether this comes back, whoever forms government, if Labor forms government, you would expect them still to press on with a version of this, whereas if the coalition forms government, you would think this would likely be dropped. As we've communicated in Express, the superannuation contribution caps and thresholds, so they $30,000 and 120, so that hasn't changed for the caps. However, the general transfer balance cap and the total super balance have been indexed up to $2 million. So there was no further announcement about that. So no changes, no stepping in. So the legislated increase of that will go ahead from 1 July. And again, we've kind of communicated what they would be in Express, but there they are. So you can make recommendations next in relation to the next financial year in relation to the higher thresholds of that $2 million. Obviously, taking into account what your total super balance needs to be to access the bring forward arrangements. Now, just on the transfer balance cap, I'm not going to go into a huge amount of detail here, but it is important now because with another round of indexation, it's extremely complex the way that indexation is applied. Again, they tried to make it as fair as possible, but by making it fair, they've made it extremely complex for people to understand. Again, there were some lobby groups saying, look, let's just simplify it a bit because it is really too hard, but no change. So in this kind of simple example, let's just have a look at it. So someone starts a credit, starts an account-based pension, let's say, so gets a credit of $900,000 to their transfer balance account. And they've got $800,000 cap space left. Now, because they've started $900,000 when the cap was 1.7, so they've used 52%, so they've got 48% left, so they'd be eligible for 48% indexation. And so then when the cap was you may recall, the cap was indexed by $200,000, so they got to take advantage of 48% of that. And that's where the indexation, that second line there, so their transfer balance cap went to 1.796 thousand. And then they started, in this example, a second pension. So they've got a second credit of $400,000. So now their transfer balance account, they've got a $900,000 credit and a $400,000 credit, taking them to 1.3. And they would then, under indexation now, because they've used 1.3 of their 1.796, they've used 72% of the cap, they'd get a 28% indexation. And under this example, they'd have an available cap space of $524,000. Now, when people are doing roll-ins and roll-outs, you have debits and credits, or if they've got lifetime pensions, it can get very, very confusing for people. So you really got to make sure you check with the client. And MyGov is still the best place. Look, MyGov, especially if they've got an APRA fund, so an industry or retail fund, the reporting timeframes on these are a lot quicker than the total super balance and contribution reporting timeframes, which are really at the end of the financial year, and they've got a couple of months to get all that sorted. These are within weeks of each other. So hopefully, if you've got someone close to a transfer balance cap, you can go onto them or ask the client to go onto their MyGov and get a fairly accurate response. Now, self-managed super funds don't have to report it as soon. They don't have a tight time frame, so you do need to take that into account. But it's still the best place to go and check what everyone's space is. So there is a lot of detail in there about you. You can go back and look at all your debits and credits and what your personal transfer balance cap is again. So there's the general one, which is now going to be 2 million, but your personal one. So anyone who started an account-based pension previously would have a personal transfer balance cap. It's going to be between 1.6 million and 2 million, depending on how much they started with and how much proportional indexation they've received. So as we go on and as this gets more indexed, it's just going to have everyone on totally different personal transfer balance caps. So the takeout is make sure you check the MyGov first. SG is going to 12% 1 July 2025, which I think everyone's aware of. And Payday Super, it's proposed to start 1 July 2026. Still not legislated, although both supported by both major parties. So we would expect whoever forms government to go ahead with that policy. It's been kicked down the road a couple of times because business have said they needed more time to set up their payroll and automatic payments, etc., etc. So that's why it's been delayed. But yeah, that hopefully should go through. Both sides are supporting that measure. I'm just going to pause there for a moment. Thank you. Yes, it was in the budget projections. Thank you. And on the 14th of March, ASIC came out with some news, like a newsletter on their website published out. ASIC targets financial advisors providing post superannuation advice through the Financial Services and Credit Panel. So this is, I felt, really important. So ASIC can escalate things to this panel and they can sit down and judge what should happen. So far, the panel, they gave a couple of advisors reprimands. They gave another advisor written direction that they had to appoint an independent person or auditor for the next 10 pieces of advice at the advisor's cost to get them all pre-vetted to make sure that their advice was appropriate. And there was another advisor that was required then to do extra CPD and training activities. Now, what this was about was a lot of it was to do with superannuation cap breaches, so non-concessional, concessional, and there was one case where someone rolled over an untaxed plan superannuation fund, say something like Super SA. Don't know if it was Super SA, could have been GESB, but an untaxed fund, or it could have been CSC. And they didn't take into account the untaxed cap plan amount and the rollover implications. But a couple of them were pretty straightforward cap breaches. And it actually surprised me because, we've reported quite a few cap breaches to ASIC in the past as a reportable breach. And talking to other licensees, they have reported quite a few as well. So I'd imagine ASIC get a lot of cap breach reports. It's a requirement. We have to report them. I haven't up until now I haven't thought it was a big thing because it's unfortunately, look, it's a pain, and you got to deal with the tax office. It takes a lot of time of the advisor. The members get worried when they get a letter from the ATO, so it's not a good thing. But unfortunately, it has happened. So what surprised me was why these advisors got singled out. It doesn't give much detail in the outcomes register. So perhaps there's more to it. Perhaps these advisors have done it multiple times, or there was more to the file than they've indicated in their 2-line summary. Yeah, so it was just interesting to point out. And then in the newsletter, ASIC reminded advisors that thanks for the glass of water, Damien.
I'm on the road.
Yeah, thank you. Yeah. Financial advisors must identify their circumstances in relation to superannuation caps that the advice provided is in their client's best interest. So that's, I think, the takeout for an advisor is, we've got a whole a big section on ASH about guidance about how to keep within superannuation contribution caps. We've got a matrix about what you should be checking, what level of detail you need to check depending on what strategy is. There's high risk strategies, cash out and recontribution strategies, tax deductible strategies where where people muck up the how much they're claiming as a tax deduction, or they forget to do it, or they do a withdrawal or a rollover before they put their tax deduction form in, or they don't claim it in their tax return. There's a whole bunch of reasons why these cap breaches happen. Um, I, I would suggest just reading our guidance and taking extra care to make sure, because it now seems to be for whatever reason, these cap breaches have been happening for quite a few years, and nothing's ever been said by ASIC in the past. But now this is the first time we've seen that they've actually started putting things up to this panel, and this panel now is taking action. So whether it's a reprimand, whether it's getting you to do extra CPD, or whatever the case is, obviously it's just, the panel then contacts the advisor as well. So it's probably not a great experience, and probably something you don't want to go through. So just something to bear in mind, that's on ASIC's radar at the moment, and they put something out 2 weeks ago on it. So that was really all that was in relation to what the government and ASIC have come out. I just thought, because there wasn't much in there, if you look at the Liberal Party website, I think, and it was at the last election as well, coalition government, their policy around superannuation and housing is that they will allow up to $50,000 to be taken out from their super to buy a first home. Then when you sell that home, you'll have to return that money back into super. So that's interesting, given the objective of now superannuation has been legislated, which is, we've put it there, to preserve savings to deliver income for a dignified retirement alongside government support in an equitable, sustainable way. So any legislation that gets passed has to reference this objective and make a comment about whether it's in alignment with it or not. So the super for housing, it's a controversial one. It elicited some strong reactions either way. So what I might do is just quickly, I will just get everyone's opinion on whether or not you think the coalition's policy, while I have a glass of water, thank you, Damien. Yeah, whether you think this is a good policy or not. So as of yesterday, it's on their website and still their policy. I think they'll probably take this to the election. They obviously think it's a vote winner for younger people that may not be that interested in super, but might be interested in buying a house. All right, just another couple of seconds. Thanks for everyone for answering. So I'm going to end that poll now and share the results. Okay, yeah, so I think most people in the superannuation industry, it's probably fairly consistent that haven't been supporting this policy, but there are some people that do support it. So thank you for that. Social Security. So there wasn't really, again, much announcement about Social Security. Now, I do note that there's nothing in the budget about this deeming, although there has been some outlets reporting that this is going to be extended again. What I think has happened is, I believe one of the ministers has made a comment that they would be extending it. There hasn't been a formal announcement yet, though, by the government. So we can't say for sure, but some outlets are reporting that it will be extended. Maybe it's just going to be part of the election pitch. We'll have to wait and see. Because it has been frozen now since 1 July 2022. It was supposed to be for 2 years. It was extended again last year so it's supposed to run out 30 June 2025. And of course, the thresholds are still going up. The income test taper rates are still going up. Income tested age pension clients are getting a pretty good deal because these deeming rates are still very, very low. Just as an example, I've taken this from Challenger, so thank you, Challenger. You can see here, going back to 2012, the RBA cash rate and that lower deeming rate were pretty much in lockstep. They're very, very, very close. But then interest rates went up quite substantially, but the deeming rates have been frozen. So they really seem to be out of whack. And the government's giving up a lot of money because they're paying out a lot of, if you're income tested, you're still getting quite a high payment because we're assuming that you're only earning very, very small returns, when in reality, you're probably earning a lot higher than what the deeming rate would suggest. To put that into some numbers, so if you're a single homeowner with 310,000 in financial assets, if they were to go back to what they've historically been, to normalise, let's say to 4 and 6%, lower and upper rate, and assuming a client's income tested rather than asset tested, it's a $5,800 reduction in your age pension benefits. So that's really quite substantial. Now, not everyone would fall into this category, not everyone's income tested, but this is one client that would be 5,800. So you can imagine how much this is costing the budget over the last few years. And if we do extend it again, it would be a hit to the budget, but obviously some age pensioners would love it. So that's pretty much all there was for Social Security. Oh, sorry, other measures. So just quickly, the energy bill relief, I think you've probably heard about. So another $75 each quarter for the next 2 quarters. Government wants to eliminate 20% of everyone's help debt from 1 June 2025. So whatever the balance is then, they would take off 20%, wipe it out. So Labor and the Greens are supporting that. The coalition's saying they won't. So we'll have to wait and see what happens with that. And Labor are also saying they want to change the minimum repayment threshold. So when they kick in, when you have to start repaying it, not only that, but the calculation of them as well. So instead of making it a percentage of total repayment income, which it is now, it'll be more like your marginal tax rate, where it's a kind of a step. It's only the portion over that amount do you make that percentage-based income payment. So I'm not going to show all the tables and numbers here because we'll have to wait and see whether this actually goes through first or not before we give that one too much attention. There wasn't too much, I don't think the government was planning to do a budget, honestly, a few weeks ago, but then Cyclone Alfred came in and delayed the calling of election. So then the government was kind of forced into doing a budget. So it wasn't probably as significant and as in depth as a normal budget was. So I thought it's now worth just talking about some of the other announcements that the government has made. Now, the Delivering Better Financial Outcomes, or DBFO. So we had Tranche 1 earlier. Now, Tranche 2 is they've concentrated on these 3 things. So they've put a paper out which is calling for submissions by the 2nd of May. So this is going all the way back to Michelle Levy's recommendations, and how to make advice more affordable, more appropriate, more affordable by keeping it appropriate. And the government's now concentrating on these 3 things, and we'll go through what they are. Well, I'm going to go through number 1 and number 3. So number 2, targeted super prompts. That's for super funds themselves. So super funds don't write out to clients giving them little prompts and nudges at the moment because they're worried about being caught under giving them personal advice. Obviously, they know a bit about the client. They know how old they are. And if they send out something to a 65-year-old saying, oh, well, have you thought about, moving your money into a pension? It could be considered under personal advice. So that haven't been doing that type of thing, that they've got to be very, very careful about what they can suggest and prompt to a member. So this would give them some carve-outs and allow them to better target some of their messaging where appropriate. But we're going to have a look at number 1 and number 3, advice through super and client advice records. So advice through super, what we're talking about here is collectively charged advice, so commonly called intra-fund advice by the industry. Now, this is a proposal that the government's come out. There has been some confusion in the past. I know a number of super funds, a number of our clients have a slightly different definition of what they can collectively charge, or what can be done under intra-fund, and what they have to specifically charge for. So I think it's a good idea to get everyone on the same page and make sure everyone's playing by the same set of rules, because the current 99F is very, very brief, and that's probably what's led to the confusion about what they can and can't cover under this. So the government's proposing on the left-hand side what you can collectively charge. So probably no huge surprise: superannuation contributions, investment options within your super, insurance held through super, and retirement income. So again, clarifying that that includes transition to retirement products, retirement income solution products, drawdowns, how much you should be drawing down, lump sum withdrawals from pensions, and longevity products as well. So that can all be done under this model. And what's allowed to be taken into account. So you can consider cash flow of your household, assets of your household, position of your spouse as well. So, which is important because that's, really to give any kind of worthwhile retirement income advice, you really need to take the whole household into consideration. So this kind of clarifies if this, submissions due by the 2nd of May. So it's, again, probably not going to be legislated before the election, but it's something for whichever side of government gets in to something to run with and provide some clarity. And eligibility for government services, so you can, work out the estimated age pension, et cetera, all done under intra-fund advice. So that's good that it would provide some clarity. Super funds know where they stand. Of course, they can charge for it if they like. They don't have to offer it under collectively charged if they don't want to. I'll note that the FAAA are putting in a submission that they don't agree with it. They think that shouldn't happen. They're obviously looking after their main interests of the independent financial advisors or financial advisor firms that don't work in super funds. So they're going to say that this goes too far. But I think most super fund advisors, most super funds themselves will be supporting this measure. And just to round that out, what is not charged under what would be not allowed to be charged. So again, pretty straightforward. Anything outside of superannuation, purchase or disposal of products outside of super, holistic financial planning, and estate and tax planning. So all that can't be charged through intra-fund. Again, I think it's all pretty straightforward. You still can take into account the tax consequences, but just no tax planning. Hopefully all that makes sense. So again, that was the first one. The second one was that I wanted to talk about was the client advice records. So this has been a long debated topic about the statement of advice. If we got rid of a statement of advice, what would need to be in it, and what do we call it? So the government's come out with a client advice record, which those that have been in the industry for a long time, it's probably something that you've heard before under the old life insurance recommendations used to have to be on a car, a client advice record. So they're looking to bring that name back. This is what they're saying needs to be in the document. You need to call it a car, same as you need to call a statement of advice a statement of advice. You need to say what the scope of the advice is, what the advice is, the reasons or basis for the advice, the cost of the advice, and who's providing that advice. So pretty straightforward. There's a lot of things that you don't need to put in there. So you don't need to restate the client's current situation. You don't need to come up with alternate strategies. You don't need to do a whole bunch of things. You might need to have on your file a bit more basis and what you've provided your advice on, like all your fact-finding information, but you just don't need to put all that into this new document called a client advice record. And the only other thing there is obviously when you're replacing one product with another, there's still going to be some replacement product information that still needs to be into that document. So at a high level, that seems pretty good. Now, a statement of advice, when you look what needs to be in the statement of advice, it's not legislatively, it's not that much different to what it is, what's stated here. Maybe there's a few extra things, but it's really been advisors and licensees and compliance departments that have wanted extra things to be in that statement of advice. This clarifies it a little bit. I don't know if it goes far enough or not. It's probably they can only go so far. It's really going to be up to the industry to take that and run with it and see how they can develop it. They've also clarified, and does this need to be in writing? And they've said, well, it would vary as to the complexity of the advice. So a written document may be appropriate when providing comprehensive advice with complex client circumstances. So you may need to put that into writing. However, maybe an audio recording. If you cover everything, all those dot points in an audio recording, maybe you don't need to put anything in writing, as long as it's all recorded. or it could be an email, just an email saying this is a customer advice record. Here's those 5 points. If it's something pretty simple, let's just say you're saying, I recommend you invest in this investment option. Perhaps an email will do, and you don't actually do a formal written document. So that will be interesting to see how that plays out and the submissions that everyone makes in relation to that. I know we're talking to a couple of groups as well about what they'll be putting in and whether we should make a separate submission or not, or whether we just go along with some of our other contemporaries. I'm just going to check the questions. Yeah, Julie, I think for your question, cash out and recontribution strategies is the objective. The objective quite often is for estate planning purposes. Look, I think it's still going to be okay. I think that it's to do with your superannuation. You might have a part of the outcome is to do with estate planning benefits, but I don't think that's the intent. So I think that might be okay. But again, we'll have to wait until the actual legislation comes out to verify that. And what's our view on SOAs? Video SOAs. Yeah, I think that's something we're definitely looking at doing. Now, for those that don't know, we've also just recently released actually a simplified advice record that we're going to be using as part of our submission. So check our website out, or if you're on LinkedIn or anything like that, and it's probably going to get some press as well. We've just put out what some different advice documentation could look like in 3 different scenarios: a simple, a kind of medium, and a more complex scenario. How that might look, a very simplified version. It's not too different to what that we've been doing this over the last couple of months. We've only just released it though in the last week or so. So it was good timing actually. And it follows pretty similar to what this client advice record should look like. But yeah, I think, David, video customer advice records. We've only gone through this thought piece at the moment. We haven't spent too much time on how can we change things now because of the uncertainty. Obviously, it's great that the government's now started to look at this. Until we get some certainty under legislation about what we can do, there's no point spending a lot of time rewriting things and rewriting our guidance rules and what needs to be into those documents until we get that certainty from the government. Once that's happened, I think now we're in a good position because we've released those documents. And as I said, come and go and check out our website, and it has a link to all those documents as well. And we'll probably mention it again in our Express, and we'll link to it as well, man. So go check it out and see what you think about those. Okay, so that just checking that there's no more questions coming through. So as I said, it was a pretty light on budget. There wasn't much for financial advisors to be aware about, apart from the tax changes, which was the biggest one. A reminder, making sure that you follow our guidance on superannuation cap breaches. Look out for those high risk strategies because ASIC seem to be targeting those cap breaches at the moment, and there could be future changes coming with this DBFO. And leading up to the election, no doubt both sides of politics will come out with some policies, but we'll have to wait and see how all those play out. Now, the video and slide of this will be on ASH on Monday. You'll all automatically be updated on your training plans as long as you've listened into at least 80% of this session live. Your cap plan on track will be updated by Monday on your training plan. Just a reminder, make sure you meet all your CPD requirements by 30 June 2025. Otherwise, you probably get referred to that panel, which I saw the other day someone did. To make sure you meet all your total hours, all your legislated areas, and all your subtopic areas as well. Okay, so I'm just about to close now, unless there's any final questions. Okay, well, thanks everyone for joining the webinar. Hopefully you learned a couple of things and got a couple of things out of it, and I'll talk to you all soon. So thank you.